SEHD is like a solid old friend. Safe, consistent, and low maintenance. But what if you could get paid weekly, with some funds yielding over 60% a year? Yes, we're talking about real weekly income. And no, this isn't some high-risk penny stock scheme. These are YieldMax ETFs, and they're built around a strategy that's turning heads. Now, don't get me wrong, SEHD is great. It's a strong, stable dividend ETF with a solid track record. You get an approximately 3.5% annual yield, low fees, and minimal drama. It's a go-to pick for long-term investors, especially in retirement accounts. But here's the thing. Some YieldMax ETFs are throwing off double-digit income monthly. For example, MSTY just paid out $1.47 per share last week. That's more than 6% in a single month. So the question is SEHD still enough? Or are you leaving money on the table? Some might say these YieldMax ETFs are dividend traps. But wait till you see the data, then you tell me. Let's break it down. Chapter 1. Quick Overview. What are YieldMax ETFs? Let's quickly talk about what YieldMax ETFs are, because they're very different from your typical dividend fund. Each YieldMax ETF is built around one single stock. It could be Tesla, MicroStrategy, Palantir, even Coinbase. But here's the twist. They don't hold the stocks directly. Instead, they use what's called a synthetic covered call strategy. Here's how it works. They create a synthetic long position using options. Then they sell call options on top of that position every week. That's where the income comes from. So the ETF collects options premiums and passes it to shareholders. That's your payout. These ETFs are designed to maximize income, not long-term growth. They target high volatility stocks where option premiums are juicy. For example, MSTY targets MicroStrategy. It uses 1.5x exposure and collected enough last week to pay $1.47 per share. But keep in mind, there's no free lunch. There's limited upside, and the price can fall fast if the underlying stock drops. Still, for weekly income, YieldMax funds are in a league of their own. Chapter 2. SEHD versus YieldMax. The fundamental difference. Now let's put SEHD side by side with YieldMax. They're both ETFs, but honestly, that's where the similarity ends. SEHD is slow and steady. It tracks the Dow Jones Dividend 100. It holds companies like Pepsi, Amgen, Cisco, safe names. It pays quarterly, around 3.5% per year. And it's designed for long-term stability, not flashy payouts. Perfect for retirement accounts or set-it-and-forget-it portfolios. YieldMax ETFs? Totally different beast. They focus on one stock, and their goal is income, not growth. For example, TSLY is based on Tesla. It sells weekly calls to generate cash. That's how it can pay you every week, sometimes with yields north of 50% to 60% annually. But there's a trade-off. With SEHD, you keep the stock's full upside. With YieldMax, your gains are capped because of the call options. Also, SEHD's price tends to be stable. YieldMax funds, they swing hard. So it's not about which is better. It's about what you're trying to do. Steady growth, SEHD. Aggressive weekly income, YieldMax. And yes, some people own both. Chapter 3. Top 5 YieldMax ETFs that pay you weekly. A. MSTY, YieldMax MicroStrategy ETF. Let's start with the biggest beast in the YieldMax world, MSTY. This one tracks MicroStrategy, a company tied closely to Bitcoin. And as you know, Bitcoin moves a lot. And that's exactly why MSTY works. It uses 1.5x synthetic exposure and sells call options every single week. The result? Very high premiums. On June 5th, MSTY paid $1.47 per share. That's in just 1 week. which, if you annualize it, is over 75%. But here's something interesting. They actually overpaid their earnings that week. MSTY generated around $249 million in income, but distributed $326 million, a $77 million shortfall. Why would they do that? Well, some say it's to stay attractive and bring in more capital. In fact, their outstanding shares jumped over 8.5% in just one day. So yes, it's aggressive, but clearly it's working, at least for now. B. TSLY, YieldMax Tesla ETF. Next up is TSLY, and this one's built on Tesla. Now, we all know how wild Tesla can be. That volatility, it's the fuel behind TSLY's income. TSLY also sells weekly call options, but it's not just about income. Some investors use it to run the wheel strategy, selling puts for extra yield. In one example from the transcript, a trader sold a put at an $11 strike. He collected $18 in premium on $1,100 of collateral. That's a 66% annualized income. Not bad for a one-week commitment. TSLY holds around $1.1 billion in assets, and it's been adding new synthetic positions, including a 335 strike as of June 5. That shows confidence in the upside. But remember, Tesla's price dropped that day by over 3%, so timing really matters here. Bottom line, if you want income from Tesla's chaos, TSLY makes it possible. C. PLTY, YieldMax Palantir ETF. Third on our list is PLTY, the YieldMax ETF built around Palantir. This one has been quietly performing very well. Palantir itself is riding the AI wave, and PLTY, even after several dividend payouts, is still trading above $65. That's impressive when you consider it launched at $50. PLTY's synthetic strategy is working. It holds a 115 synthetic strike, while Palantir is currently around 130, so it's comfortably in the money. Now for their weekly trades, as of June 5, their lowest strike is 130, just barely in the money. Other strikes go up to 139, which is about 7% out of the money. So it's all about whether Palantir stays flat or drifts up. And for now, it looks like PLTY is in a sweet spot. Some folks are even calling this one the GOAT in the making. We'll see, but so far it's earning that reputation. D. CONY, YieldMax Coinbase ETF. Next is CONY, based on Coinbase, another high volatility asset. Coinbase moves a lot, and so does CONY. Here's what makes it powerful. CONY holds a 250 synthetic strike, and on June 5, Coinbase was trading at 256. That's right in the money. Why is that good? Because they're earning premiums and holding a profitable synthetic. Their weekly calls range from 255 to 277.50. That's 4% in the money, up to 8% out of the money. It's a wide spread, but it gives CONY room to collect income and chase upside. The fund holds about $1.1 billion and trades near NAV. One thing to note though, they didn't have new trades on June 5, so this week's income will depend heavily on market direction. Still, for people bullish on crypto volatility, CONY gives a weekly way to play. E. SMCY, YieldMax Super Microcomputer ETF. Last, we've got SMCY, a newer fund based on Super Microcomputer or SMCI. This is one of the more niche tech plays. But here's the deal. SMCI has extremely high implied volatility, over 70%. That's what makes SMCY special. On June 5, they held a 45 synthetic strike, and SMCI was trading at 44, just about at the money, perfect for collecting premium. But it hasn't been smooth sailing. One of their positions was 4% in the money and had to be closed, likely at a loss. Still, they rolled that into a new strike at 48, giving themselves more cushion. The fund is smaller, about $176 million in assets, but the income potential is real. SMCY didn't post a big gain on the day. It captured just 0.91% of SMCI's 2.1% jump. So not perfect, but it's holding up. For AI and server growth exposure with income, SMCY is a unique pick. Chapter 4. Risks and Limitations. Now, let's talk about the risks, because with high income comes high responsibility. First, YieldMax ETFs don't own stocks directly. They use synthetic options, made with options. That means they're tied to price movements, but without actual shares. Also, these funds cap your upside. Because they sell calls, they give up gains above a certain price. If the stock runs, you don't fully benefit. Second, volatility matters a lot. These funds rely on high implied volatility to collect premium. When IV drops, so do payouts. That's why MSTY's projected payout dropped from $1.47 to just 93 cents in 1 week. Third, these ETFs can overdistribute. For example, MSTY paid $326 million, but only earned $249 million. That shortfall has to be covered somehow, often by using new money coming in. So if inflows slow down, payouts might too. And finally, there's price risk. If the underlying stock tanks, NAV goes down fast. This isn't SEHD. These funds swing, so they're not ideal for your core portfolio. But as tactical tools for income, they can be powerful if used wisely. Chapter 5. Final Thoughts. So, what's the takeaway here? SEHD is reliable. It's built for long-term wealth, not short-term thrills. And for most investors, it belongs right at the core of their portfolio. But YieldMax ETFs? They're different. They're tools, not anchors. If you're looking to generate income and you're okay with some risk, then adding a few YieldMax funds could make sense. Just don't go all in. Diversify across tickers. Understand the strategies. And most importantly, track the NAV, not just the payouts. Because yield without context, that's how people get burned. If you found this video helpful, go ahead and tap that like button. It really helps the channel grow. And I'd love to hear your thoughts. Have you tried any YieldMax ETFs? Do you think this kind of income is worth the risk? Drop a comment below. And hey, if you made it this far, type weekly income in the comments to let me know. Thanks for watching. I'll see you in the next one.